basically, before we begin, I'll ask you to introduce yourself so that I don't omit anything from what you do. I think it's let's start with that.
Fantastic, Peter. I saw your points of contention firsthand on Tuesday evening, so it was absolutely great. Really looking forward to this. My name is Cathal. I'm the president of NexStox. We're licensed across multiple jurisdictions across Asia. What we're offering is different types of offerings, solutions, exchange services, distribution protocols, and giving people the ability to list, which allows them to have access to global markets. So really looking forward to this panel.
My name's Terence. I'm the co-founder of EXIO. We are one of the licensed exchange VTP in Hong Kong. That's the one of the 11 that Under Secretary just mentioned. We managed to acquire the license back in 2024, and the reason that we come in to apply for the license because back in 2022, Hong Kong government laid down the whole regulation framework, and we think there's clarity and consistency of this the whole industry. So we come in to apply for the license. Now we are operating as one of the VTP in Hong Kong. Two of the areas that we are mainly focused is the first thing is on-ramping trading. The second thing is RWA tokenization and listing. Because we are one of the licenses on Hong Kong, we are able to allow the RWA token not just being issued, but we have the secondary market for that to trade. We are working quite a lot with a lot of RWA projects and then list their token on our exchange. Yeah, thank you.
Yeah, thanks for having. Hello? Oh, we go. Yeah. Thanks, Peter. Ivan, thanks for having us. I appreciate it. You guys put in a lot of effort to bring everyone together. Hi, everybody. I'm Julian, Kwan. I'm co-founder and CEO of two regulated RWA platforms. InvestaX is out of Singapore, broker-dealer exchange license. IXS is licensed out of Bahamas and has crypto custody and retail securities. Yeah, we're excited to be here, talk all things RWA. We've been in the space since 2018. We're opening up in the US this quarter as well.
Good morning. Good to see you again, Peter. So Scott Thiel, co-founder and CEO of Tokinvest. We are a regulated broker-dealer and RWA issuer headquartered in Dubai, regulated under the VARA framework. Great to be back here in Hong Kong. I spent 11 wonderful years here working on some of these issues as well, and fantastic to see what's been happening in the local market with the new VATP frameworks, etc. In addition to what we're doing in the UAE, we're very interested in building and partnering with asset owners and issuers and regulated counterparties in this market to really build that greater China, UAE sort of digital corridor of finance. So great to be here.
Great. Let's begin with I'll make a statement, and I'm interested to hear the feedback. So. We did a little trial a couple of days ago, but I think this to me makes sense. That's why I want to share it and do it as the opener. From the perspective of the investor who's looking for funds in a crypto world, and currently our funding is 98% driven by the corporate bonds from the real world. And approximately by 2% currently from crypto equivalents. I'm looking at the trends and how things work. What I see, and that's up for discussion, that real world asset is dominated by assets which are anyways available in the real world, US treasuries, gold, etc. To me, it makes sense that platforms, and you represent this part of the business as far as I can tell, it's natural to use that as a starting point because it's safe. You know that if you offer US Treasury as a real world asset, then it's economics is understood, risk is understood. There's no question about it. A lot of new and potentially interesting projects are out there, clearly. But I guess the biggest problem, it's a problem which might be resolved with time, hopefully, or with the capacity of the platforms, are related to the fact that those who were not able to raise money in the real world, they're reaching out to crypto as a potential miracle. Oh, this is a new source of funding, let's go and try it out, it doesn't cost that much. So all these projects are coming in, and you're facing them, I would assume, right? So it's a problem of selection, and clearly it's very interested to hear whether you would agree that this is the tendency currently and how you cope with it.
So Peter, when you mention your product in particular, there's one key point about it, and that is scalability, correct? It's a scalable financial product. Now, when you look at a lot of different entities that are approaching different types of exchanges, looking to raise capital, what's a big problem? They don't meet the criteria to qualify for this capital, be it by way of loans from banks, be it by way of direct investment, and so forth. And that's a major problem that exists. Now, what we're seeing right now is that a number of these entities are being weeded out, and it's largely shifting towards more credible products. Let's look at US Treasuries. If you look at the TVL that's on-chain, what would you anticipate it is? On-chain US Treasuries.
In terms of what, percentage of the offering or what? What do you mean?
Total value locked.
Well, I would assume that's one of the major, I mean, from the total, it will represent the majority. In terms of money, I don't know, but in percent, I would say is the most.
Absolutely. So you can see that it actually solves a major problem. It allows for direct access into US Treasuries that was previously unavailable. What else has it done? It's reduced the ticket size. So it makes it much easier for a retail level investor to get involved, to get exposure to these different types of assets. And the other thing is, it's not limited by border, it's not limited by jurisdiction. Of course, yes, there are compliance protocols involved, but it allows for direct access, direct ownership that's immutable, on-chain, and fully democratized. So we're seeing that shift in towards financial products which are scalable. Now, for certain institutions, you can make the argument. Tokenization basically makes what was previously available to them available again in tokenized format. What should be looked at is who tokenization solves the problem for, and that's the retail market. So right now we're seeing that shift from projects that wouldn't otherwise be able to access that capital towards more reputable projects, leveraging tokenization as a means of inclusion. And those are the types of projects we're talking to on a frequent basis. They're those looking to diversify their audience and to allow for global inclusivity. And that's the exciting thing about it.
You asked us to disagree, so I'm going to jump in. US Treasuries has been a success story at one level. If you look at TVL for an on-chain asset, I don't think it's achieved any of the objectives of retail access. The largest value version of a US Treasury on-chain is BIDL. It is a $5 million minimum subscription available to accredited investors only. It's a digital transformation of a product for the benefit of large institutional financial players so that they can park their money instead of dollars in yield-generating dollars for the few hours overnight that they aren't able to deploy them in other ways. So that's not to criticise that product in any way, but I think where I do agree with you is I don't think that has been a success story for the opportunity. I do agree the opportunity is the retail access, the ability to raise capital for projects that don't fit into TradFi's qualifying criteria, and the ability on the buy side for retail participation. Retail participation has shown its interest because of its mass adoption of crypto, NFTs, meme coins, highly volatile, highly speculative assets. I think the problem still with the regulatory framework for RWAs is, with the exception of VARA, which is one reason why we've set up in Dubai, is we can service retail investors. And I know this is a conversation you and I, Peter, are having quite deeply in respect to the LynxCap product. But regulators are still saying, for the vast majority of financial products, you can only buy it if you're rich, which is an accredited investor. So you have to solve that unlock. Is that going to be solved at the level of regulators like has happened in Dubai, where they permit retail access? Or is it going to, and that's why I jumped up and looked at your slide, Peter, is it going to be solved by self-custody of these assets and those becoming composable assets in DeFi and then accessible in that world? And I suspect that's going to be an easier thing for regulators to tolerate, so it may be that. But I'm not sure what we've seen so far has really solved that retail problem.
So Scott, there's a major point in the Dubai framework. What's been the major benefit there? It's allowing for lower ticket sizes to be able to have exposure to Dubai real estate. And it's been quite successful in that regard. So that is ultimately the point that I would see it. But Julian, you had the microphone there.
Yeah, well, I think part of the question was like, are people just doing this to raise money? That used to be 100% of the inquiries. And they were all, the very first RWAs were all failed ICOs. They couldn't raise any money. So that journey over the last couple of years has gotten better, mostly in the last 12 months with like America coming on market, the concept of everything moving on chain from a finance perspective. Yeah, you have a growing number of groups that are turning up. The more professional and the more experienced the asset issuers are, the less that they think that they're going to get free money by tokenizing. So it's basically just a spectrum. Like, if they don't know what they're doing, they will say, I'm going to do this, I'm going to raise hundreds of millions of dollars because, I don't know, that's just what they think. And you find a $1 billion asset manager, they're like, why would, of course we've got to lead the fundraising, it's our asset. This is a new format, but it doesn't just mean you can list anything and money falls out of the sky. So it's definitely improving. There's still a lion's share of people who think it's just a money grab, and they all fail.
Okay, just to adjust Peter's question about there's quite a lot of projects coming out trying to raise money. Actually, last year, Hong Kong, there's a super hype on RWA. I think it's around like May and June, something like that. At that period of time, there's more than 150 projects coming to our exchange to say they want to do RWA tokenization. They're looking for investment from crypto space. But to be honest, I think there's, from my point of view, I see there's a mismatch of the supply and demand, because when we think about like RWA asset, usually the returns, the yield is more stable, and it's not like to be honest, at that time, especially at that time, the expectation, the return expectation doesn't really match what crypto space people are looking for. So what we see is I think at the end of the day we need to consider like, okay, the real world asset after tokenized, who are you going to sell to? Who are you actually serving to? My belief is that actually we are serving the traditional market, not the crypto native people. The crypto native people looking for one day 100% return. Okay, that's more like I would say it's more like gambling style, right? But real world asset, the purpose to serve is more on investment side, right? You're looking for really sophisticated person. So there's a problem with that side. How much money in traditional finance in the crypto form now? Right? There's not so much. Right? Most of the money are actually sitting in US dollar, right? in fiat. And then where's the channel for them to come in? Right? You talk to the family office, you talk to the banks. The money is sitting in the bank, and then how is the channel for them to convert that into crypto, right? So that's also why we are trying to solve this by two ways. The first way is we allow people to trade through OTC, converting their fiat money into stablecoin, right? Could be any stablecoin, could be like the upcoming Hong Kong license stablecoin, could be USDT, could be USDC, that's fine. And then on the other side, we are working on bridging all those real assets to tokenize, right? We need to move these two things on chain and then provide an exchange for these two things to meet together, right? With a license channel, right? Because if you want to like tap into just tokenize that, and then you want to tap into the TradFi market, the first thing they ask is like, is it my compliance team allow me to do that, right? And then you need a license for that, right? So that's why we are trying to do these two things together and try to channel that to the bookers in Hong Kong. They can connect to VATP, and then they can buy those tokens on our platform. We try to provide two ways of doing that. One is order book, like secondary market trading. One is OTC, like kind of like request for call and then trading, that kind of way. It really depends on like what kind of asset you're trying to sell to the industry, right? If it's a very vanilla product like commodities, we can tokenize gold, silver, any commodities, right? We can also tokenize water, right? And then you can also go for some more exotic stuff like real estate, bad debt, right? Even some project financing, we are working with that. We even tokenize our own convertible bond. That EXR, we issue a convertible bond on our own equity. And that is also one of the ways. And then if it's a more exotic stuff, then the trading mechanism have to go to like kind of like OTC platform. Yeah.
Let's deep dive into this, in my view, very interesting elements which you highlighted. I think that discussing, and it's clear that ability to access certain commoditized products which are anyways accessible through different products, ETFs, stocks, and whatnot, might not be super interesting to discuss. It's there, it's obvious, it dominates the market. Let's talk about the use case of real world asset for something which can be new. Yeah, not only by giving access with a smaller ticket size or economies of scale and efficiency. I guess we all understand that. I'm personally interested from my angle to understand several elements to capitalize on what you said. So if I may summarize correctly, the capital which sits and has been accrued on-chain, required yield for that is significantly higher than in conventional investment world. That's statement number one. Therefore, a real-world asset would be not the right product for this capital, simply because it's just real-world asset by definition is linked to GDP growth rate and all these elements, which naturally limited to total factor productivity and macro factors. So it's not always the right product per se. And therefore, my question is, the capital that is looking for this real-world asset product, why is it on-chain in the first place?
To address this question, actually, I think it's like that, right? We need to, why they want to move on-chain, I think it's a matter of like, is it there some investment opportunity over there? Or are the assets compete over there? And then, is it the transaction fee, is it lower, right? From what I see is like nowadays, what we are trying to do is like we bring the asset on-chain, people want to try, and then they see that, okay, actually the way to invest in this kind of product, the fee, the whole process is a lot easier, right? It's more transparent.
Can you make an example with concrete numbers so that just to visualize it?
Take for example, right? If you one of the projects that we come across is kind of it's also very new to me because I never heard about that. So there's a oil tank shipping into a pot, and then before the oil tank doesn't pot into the pot to download the oil, but there's another ship that moving in between the pot and the oil tank, and then that ship actually can make some yield, right? The yield is pretty high, to be honest, and then they want to tokenize this ship because they generate yield, right? For this kind of project, think about that. In traditional finance, I think that is not very transparent, and then it's not much people being access to this kind of informations. And from my point of view, with a crypto project, you being tokenized that, you basically expose this kind of investment opportunity globally, right? Because that is the beauty of a blockchain, right? It's not just limited to Hong Kong. it's also exposed to any other places. Some of the things that I'm also trying to do is I talked to some of the project in UAE. Actually, we're also trying to apply for the license in UAE and also Bahrain. They have some tokenized project. I'm trying to distribute their token in Hong Kong too. So you can see like the benefits, like when you tokenize that, you immediately face to
Okay,
global market.
this is another super interesting discussion.
Yeah.
I'll get to this link between the jurisdiction, Julian, but Scott.
I'd like to jump in on it because I disagree with the suggestion that on-chain capital isn't looking for RWAs. Actually, on-chain capital is really looking for something that isn't a highly speculative, highly volatile crypto asset that is simply providing yield through crypto emissions, which is a zero-sum game. We all know if we're honest about it. But what's been built in that Web3 ecosystem in terms of the financial structures, the ability to enhance a product through things like looping, the use of vaults, the use of an on-chain asset as collateral in that context. So for us, it's about, almost regardless of is it a real-world asset or is it crypto, it's like, what's the reason for doing this? Who wants to invest? And the gap that exists between the traditional investor in the real-world asset and the on-chain investor is, in fact, yield can be boosted. You can take an off-chain asset and you can, if you digitize it, you can boost yield. So you can always make a better product if that capital will come in. The challenge, I think, is a combination of the yield, but also the redemption profile. Traditional financial services assets have slow redemption. It's slower money. It's money that doesn't need to be returned tomorrow. But the Web3 industry is used to having very high liquidity for their Bitcoin or whatever else, and they can exit like that. And for us, therefore, you need to build products that provide the yield profile and the redemption profile. And then that money in on-chain capital is desperately looking for that product because of the risk and constant monitoring required to deal with these volatile crypto emission products. So that's what we're working on, is how do we marry those two together.
But this is impossible trinity, right? You have either the yield or liquidity. You have either the money market fund or your duration risk. How you...
We'll take it offline and show you some examples, and I'll get you to meet Daniel later, who's up the back. I won't point at him.
So I would actually disagree with the part about the trade-off there. If you look at why DeFi Summer happened, why did it happen? Simply put, DeFi protocols were offering substantially higher returns than what they could otherwise get. That demand is still there. It hasn't changed. The demand for yield was proven in 2020, 2021. But what was the problem back then? A lack of reliability, a lack of a safety net. And that's ultimately the reason, as far as I'm concerned, for RWA and the problem which it solves. It's access to that yield. It's that factor of reliability, that stability, that regulation, that security. You look at certain delta neutral trading strategies, they're offering between 15 to 20% APY. Those returns are there, they're scalable, and it's offering the same benefits that were available during DeFi Summer in a reliable format.
So,
I was going to say, I'm trying to remember the original question, but I think it's different times. So the original RWAs were all private assets, and no one was it was very hard to scale, like most private assets are. And then along came the tokenized treasuries, the financial instruments. 2 years ago, give or take, a couple $100 billion stable coins earning no yield. It was all the professional stablecoin holders, like the crypto hedge funds, that were buying the treasuries for yield. The degens weren't interested. But that actually was the first product market fit by any type of scale. So US dollar yields versus DeFi yields. That is evolving with all the financial instruments. It's created another flywheel where now all the private assets are coming back to do it, better quality versions. We had something like 74 inbound inquiries last month. Probably 5 are really high quality, and don't know about the rest. But yeah, and ultimately, it's a different time now. You know, the US Treasury Secretary has said he's going to print trillions of dollars of stable coins because it increases US dollar dominance and it's a forced buyer of US dollar debt. So if $200 billion on sort of day one of RWA put, I don't know, $10 billion, $20 billion of treasuries, and then most people still hadn't even done it, 5, 10%. You can start to see there's going to be, there's not, and that was just crypto people 2 years ago. Now, because of TradFi coming in, a lot of the stablecoin holders won't be getting stablecoins to buy crypto. They'll be taking 10 basis points earning cash out of the bank, putting in a stablecoin and buying a private credit token at 12% on chain. So there's now a whole new world of people that don't really even care about crypto. And that's going to change everything as well. But it was crypto guys that bought the first, it was crypto guys sitting in stable coins who were the first real buyers, but it wasn't the degens, it was the professional traders.
I definitely agree with that. I think the geography demography is all changing, because like previously most of the people coming into crypto, where's the yield coming from? Is from the directional of the price of movement of Bitcoin, ETH, and that kind of thing. And I think where's the yield coming from is mostly from the leverage, right? People trading perpetuals. Intrinsically, there's lending between from the people who provide the funding to those people who want to take that leverage. When the market is volatile, you have a bigger funding fee on that. Those are the yield that transfer from those platforms to the whole industry in crypto degen people. But nowadays the market structure is changing a little bit, right? More and more TradFi money come in, and then they're looking for more stable income. So the thing is, we have to bridge this RWA with those new investor on chain. Yeah.
Let's make a bridge here to the next topic, where I think nicely fits into the whole picture, and I'm personally very much interested to hear what you would say about it. A real-world asset as an asset class does not have geographical boundaries. You were mentioning the ship story. It can be equally local and global. For me, as the investor, I'm imagining, if we're talking about serious money, there is a certain set of requirements. And this comes to very basic elements, which I highlighted in my one slide to try to capture it. Before I ask the question, I'll make an example of our experience in the real world. The real world, the way we operate, we have a placement agent, different jurisdictions, US, Europe. It's two things are important. Trust between the issuer and the placement agent takes time. Usually it's very local. So, you know these people, they know you. Unless you're a $500 million fund from the get-go. And second element is the domiciliation of assets. For example, investors like to buy into something which they feel is close. This is the problem we're having. It's a challenge, it's interesting. Our funding from Asia is overall, I think, less than 5% from overall investment book, because Europe is far away. And we feel that people are more comfortable with buying into something which is local. Now, real-world asset token gives ability to place money anywhere in the world. But how do you give this comfort is there a demand for this to people about where's the asset, how is it enforced, who did you due diligence, and all these elements, in your view, to what extent they're important for people who are placing the money, and how can you procure that it's being to let's say, your satisfaction or to the satisfaction of the investor?
I mean, for us, under the VARA framework, the credibility of the asset, the investor protections, the bankruptcy remote, and all those structuring things is why it's a regulated asset that we're issuing. So, and actually, just as I was coming here this morning, I see that VARA has received a formal appointment as a competent authority under the federal regulatory frameworks in the UAE. And so that whole kind of, it's a regulated product, it's required regulatory express approval. That to me gives it that, the confidence of the investor. I think more subtly, but more importantly in your point, I think is who's interested. Are they only interested in a local asset? So we are about to bring to market a tokenized build-to-rent property in the UK. Who's interested in UK property? Well, this town has a habit of buying a lot of UK property. So we are going to be promoting that asset in particularly Hong Kong and you know other markets in Asia that have a strong interest and connection with UK real estate, and that's product market fit, you know, as much as anything. And so I think there's two things there: credibility of being a regulated issuance, and we are seeing RWAs now increasingly. Some of the conversations I've had this week with people, and it's taken me 3 sentences, questions to work out. They're pretending they're regulated RWAs and they're not, and that is dangerous for the industry. And Web3's had a lot of own goals in that area, and this is now the hot topic, and it's going to happen again. But for us, regulated product combined with product market fit is what's going to work.
Yeah, I think everything Scott said is valid. I think also just think about the different types of RWA. So if you think about a tokenized treasury, people aren't reading up 40-page prospectuses to find out what it is. Therefore, it's become the most scalable. People are taking it in DeFi pools, illegally or not, I don't care, but that's happening. People are lending against it, and it's very easy to understand. And then the flip side is someone's startup token, and that's, forget the token's just a shareholding structure, still have to find an investor, explain what's going on, explain if there's any extra use case, can you lend on it, borrow, is there any type, it's all, 99% of the investment discussion remains exactly the same. To try to get someone over the line. So the private and the public assets have been very different, and that's why the first years of private assets were very difficult to scale, and now we've finally found scalability in the public assets, even though tokenization, in theory, on paper, probably adds more value to private assets than public assets, but now they're all coming on board. So it's very much an interesting and an important decision for the platforms to think, like, when we're putting these assets on, like, how hard is it going to be for people to understand this, and how scalable is it truly? And and then you can see the results on chain, and that's the way it is.
So recently, a friend of mine actually resigned from a major RWA protocol because he came out with one line: when you move these assets off chain, they're worthless. So the lack of an standardized on-chain and off-chain linkage, that's been a major problem for the industry beforehand. Now, Julian, you made a very good point too, that RWA has been particularly good for private offerings and making those available and accessible. Right now, what we're starting to see is public offerings being more readily available in a tokenized format by way of distribution channels. But it's also important to look at a number of other things. Number one, why did crypto become big? It's borderless. It allows for that accessibility. It allows for that distribution framework. And it's not subject to trading hours. It's available 24/7, 365. That was ultimately the reason why crypto became big, because it was borderless, not necessarily because it was close. You knew who the founders were. It was because it allowed for that global accessibility. So while that point is certainly valid, that will evolve over time.
Yeah, regarding this question, actually we are doing it very conservatively, right? But one of the reasons is because we are regulated under SFC. The listing, the tokenization of the underlying asset, that have to run through a very concrete due diligence, all those stuff. The leasing process also include a lot of study on the project, on the underlying asset itself. But I do see the trend of relaxing how the process is going in a regulatory framework. It's just a matter of time, right? And we are trying to be honest, we are trying to explore different type of asset. Can we tokenize that under regulatory framework? That what I mentioned is we tokenize a fund, private fund. We also trying to tokenize a convertible bond, and now we're trying to see private credit, goals, other commodities. And then it will come into some of those project financing. That may be a bit difficult. And then I would say at the end of the day, you need to lay down all those models and make sure the product disclosure is done in a perfect way, and being transparent to the investors. Yeah, that is what we are doing. And we're actually doing it very slowly.
I think this is very important what you said last, very slowly. You can't do good, qualitative, great things fast. It's just against the way nature works. I guess, yeah, we are gonna take a few questions if we, yeah.
Hello, thank you very much. This is Dr. Qin Xuan from the Art Science Funds. Question to you, can we make that investment more generic for ordinary people, you know, to get rich? Because in that RWA is real world assets, so we have that insurance to guarantee the all the ecos are really can get the minimum 5% return, whatever. So in that case, on-chain capitals, can we introduce that reinsurance to make sure the investment get guaranteed kind of return? So in that case, will be wet up the application for everyone to join this RWA applications. Thank you.
I mean, this is the reason we started Tokinvest, is democratizing access to, you know, well-managed, capital-insured, well-structured, regulated products. Traditional finance regulations say you can only buy those products if you're rich. If you have $1 million of liquid capital, there's different definitions, but basically that. It's not something that has moved in most jurisdictions yet. You know, you made the observation about why did crypto take off? For me, it's really simple. There was a buy button and anyone could push it. Regulated assets, there's a buy button if you're rich. And that's the problem. And it's the reason we've set our business up in Dubai. It's because our license allows us to service institutional qualified investors and retail investors. So the technology allows it. I think there's demand from people to participate, as evidenced by retail adoption of crypto. But regulatory frameworks in many parts of the world are still not supporting it. And I think what's going to happen is those assets will go into DeFi and retail will buy them there. And the danger with that is you're then not getting a guaranteed regulated product. So I don't think preventing retail from buying a regulated product is going to stop retail accessing it. I think it's going to mean retail might end up buying less good versions of it.
So you made a very good point there. It's all about allowing for that accessibility. And when it's more reliable, more regulated, and available through licensed partners who have conducted the due diligence, and that's a very important part. Peter spoke about the element of trust. Do you trust the platform to do the due diligence? Do you make sure that they've carried out the relevant checks? Is the on-chain ownership recognized off-chain? These are the very important parts. And really what it allows for, it's not just the distribution, but it's also to prove the product market fit. Are people buying it up? And that then gives you the justification to scale. So ultimately there is that validation. And when you make it easy, I like the analogy you put there, which is that there's a buy button, you can press it. And that same benefit is there. So when you have lots of people coming in with much smaller amounts, people vote with their feet. And that's ultimately the validation that's required.
I'm getting a sign that we have to finish this interesting discussion. I hope you enjoyed it. I certainly did. Thank you very much for the panel lists and to you as well.